So I went short here on Nasdaq using the market maker sell model, where we swept out London highs. We had relatively equal lows as sell side liquidity. That was our minor sell side liquidity. Then we had major sell side liquidity being the London lows, and then we was able to leave runners. Previously, like last night, I wasn't able to catch a trade because my criteria wasn't met. However, the criteria from the previous day was met today because we wasn't able to do it last night. So in hindsight, for later I've really journaled this finding because I could really utilize it. The way I trade, I could utilize it later, but I want to just go over how I managed this trade. So price started pushing in my direction, showing me very bearish order flow. So we were getting speed past lows. We was respecting bearish fair value gaps and then pushing lower. So I just kept expecting price to just move lower and lower and lower and lower. Because of how price was moving, I didn't expect big candles in my direction, but I expected price to use speed below lows so I could watch how price moves when it's in between the gaps. So if we talk about my stop loss placement, from where I entered, that to me was my breakaway gap. So price had two gaps. The first gap, price didn't come back into that gap. The second gap, price came back and showed that we didn't want to go higher. So what did I do? I waited for the inversion fair value gap on the 1 minute time frame. The inversion fair value gap on the 1 minute time frame shows me that sellers are more in control here. We got an inversion fair value gap, we got a silver bullet, and the price is moving down slowly and showing me showed me bearish order flow. So when I want to move my stops, when I can start seeing speed below the lows and carry on going in my direction. And then later in this trade, I was able to see that price had created another breakaway gap, so I had to move my stop loss straight to break even because that was where the breaker was. So if we talk about the time of this trade, it was way before pre-market. So covering my stop loss pre-market was the safest option for me because I didn't want to be swept out and get spiked and lose some profits on my accounts. I want to be out of the trade and able to get in a new and better trade if price wasn't to go my way. So I had to cover my risk just above the breakaway gap, and hope price didn't return to that stop loss, which it ended up just flushing down about here. So we've taken sell side liquidity, those relative equal lows. What did I do? I wanted price to move more in my direction. I didn't want it to flip straight away. So I kept my full trade in to see if we could get a stronger push below those lows. And what did I do? As soon as we got that major push, I ended up taking 80% of my trade out. That's 16 contracts. And then I left 4 for the runners. In my opinion, this was a good trade because this was a market maker sell model. I followed my rules, criteria, everything was met, and price ended up going all the way down around 400 points, 400 or more points, and that was great for me tape reading. That was great for me to tape read the executions, I was able to see a lot of things happen, a lot of levels that would hold and really react from, and it was just a great day. So yeah.